Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. This is a special all-mailbag edition of the Final Bar. We've had so many great questions recently. We also did a live Q&A earlier this week. We have tons of good questions. Thought we could spend this show going through some of the best ones we've received here recently. Please keep them coming, though. As a reminder, our mailbag is always looking for more mail. Any questions that come up as you are analyzing the markets, as you are using the StockCharts platform, as you're trying to make sense of things, as you're using different indicators, looking at particular tickers or ETFs, just let us know. Our email is thefinalbar@stockcharts.com, and that's the best way to get your questions in front of us. Let's get to question number one. If the economy is changing to a world where stocks and bonds travel in the same direction, how would you use technical analysis to identify this change? I got a couple questions, actually, similar ideas, all related to the relationship between stocks and bonds, and particularly thinking about that relationship. And I'll tell you, right at the top, there is a reason why, or there is an expectation, I think, for a lot of investors that relationship is very stable. And I actually remember when I took a CMT exam a couple years ago, I remember writing down stronger dollar, weaker commodities, stronger bonds, weaker interest rates, stronger stocks. And that was the relationship at the time that was pretty well established. A lot of those relationships are fluid. And I think what I've learned on 23 plus years of doing this is that those relationships are not static. And honestly, John Murphy, who wrote a fantastic book called on intermarket analysis, which I would highly recommend, certainly, talks about those relationships. And in the future version, these subsequent editions, he really talked about the changing conditions, how those conditions are very fluid. Bob Prechter did a number of presentations that I've seen talking about how, just very simple things, thinking about, gold goes up when stocks go down. Gold is a safe haven, right? So if stocks are struggling, gold goes up. That actually works very well part of the time, right? Sometimes. Other times, stocks and gold actually move together. Same with stocks and commodities, stocks and interest rates, particular sectors. Those relationships are not as hard and fast as we would love to think. And I think as investors, we often want to oversimplify and just try to come up with a simple relationship. If this does X, then this other thing does Y. It's just not the case. And I think that is a great argument for technical analysis. Instead of thinking about what the relationship should be or must be, think about what the relationship is and be open to the idea that conditions could change. So with that in mind, what kind of technical tools would I use to define that relationship and then kind of think about it? So actually this week on the Final Bar, one of the charts we featured as a 3 and 3 chart was this chart right here, which is just looking at the simple ratio of stocks versus bonds. Now, this doesn't particularly answer your questions about, if one goes up, what is the other down? It goes down. This actually just looks at the relationship between the two. So when this ratio is going higher, stocks are outperforming bonds, and I'm using the SPY and the TLT. When that ratio is going lower, stocks are underperforming bonds. But they could both be going up. But if stocks are going up more than bonds, then the ratio keeps going higher, obviously. So recognize that for the last 3 years, stocks have been outperforming bonds, and that's in bull markets like 21 and 23. That's in bear market years like 22, and everything kind of in between. That overall larger trend has been positive. Now, the reason why that's the case, and this is one of the charts that I would definitely point you to, go to Charts and Tools on StockCharts, go down here to where it says Historical Chart Gallery. This says Important Market Indexes. Click on Bonds, and you are faced with the 30-year yield. Look at interest rates from the mid-1940s. This is World War II years, all the way up to the peak in 1982. So during this period, rates were fairly consistently higher, even though there were some brief pullbacks, like in the early 70s. Overall, the trend was very, very positive. Then from 1980, we'll call it 82, down to 2020, yields were in a downtrend. This is a huge 40-year bull market for bonds and a downtrend in interest rates. So interest rates here, of course, getting to, incredible lows, all-time lows even. So the rise that we've seen in rates, when people talk about, could rates get higher than 4.25, I immediately have this chart in the back of my mind reminding me that there is no upward boundary to where the long bond yield or the 10-year yield could be. Theoretically, it can go way higher than it is right now. So while this seems high relative to recent standards, 4.25% on the long bond is actually where we were right around the financial crisis. And if you go look back, that was actually a pretty low level. The average is kind of up here somewhere in the 6% range or something like that. So rates certainly can become higher. So what kind of things would you use beyond those charts to pay attention to? I like to do a simple analysis on both of those two. I would think of them independently. I would look at the chart of $TNX, which is the main thing that I would use for interest rates. I see this as being in a pretty good uptrend for the last 6 months. Another thing you could do would be look at the TLT or the AG, which will look at bond prices. You'll see those are obviously trending lower. Compare that to the chart of the S&P 500. I tend to think of them as two separate charts, right? Analyze chart number one, analyze chart number two. Are they agreeing? Are they not agreeing? Do a traditional technical analysis based on the founding principles of the technical toolkit, and I think you'll be led in the right direction. But recognize that those are not explicitly defined relationships. They are much more fluid than we want to believe. Question number two, what's going on with the weekly put-call ratio? I love the straightforward nature of that question. What is going on? I made a weekly chart of the equity-only put-call ratio to use here. I'll try to remember to put a link to this chart in the description for the video if you want to access it on the StockCharts platform. This is weekly data on the put-call ratio going back about 10 years or so to 2014. Now, this is a weekly reading, so you have to remember when you're looking at, put-call ratios come out every day at the end of the day. And so, looking at weekly data, we're just looking at the Friday closing reading going back over time. And I think what we're talking about is this, which is the put-call ratio has spiked very high recently. And you're absolutely right. And if you look at the weekly chart, you can see we're at some of the highest readings we've been at for decades. What does this mean? So the put-call ratio tends to have an inverse relationship to equity prices. And what that means is when stock prices sell off, investors tend to get a lot more defensive, in fact, more and more bearishly positioned as the market sells off. And that's why the put-call ratio, the put side, which is the numerator, gets a lot bigger. And so as a result, the ratio goes much higher. In bull market phases, when the market's in a nice uptrend, the put-call ratio tends to get lower. Think of it like the VIX. It's kind of a similar, different look, but similar kind of general inverse relationship as you'd see with put-call. So when the market is in good shape, investors are more bullishly positioned. They're more in calls than puts. As a result, this ratio gets very, very low. I put a horizontal line when this ratio on a weekly basis gets above 1, meaning a 1-to-1 ratio of puts to calls. So you can see on average it's actually kind of below 0, right? In general, there are more calls than puts. There's more bullish positioning than bearish positioning, which is pretty much right if you think of the long-term trend in equity prices. But when this gets above 1%, I put vertical lines to illustrate where that is on the stock market chart. And again, I would be careful about the causality. I don't think a high put call ratio means the market's putting in a bottom. I think when the market sells off, that causes the put call ratio to be elevated, right? So the uncertainty, the defensive positioning spikes, and that high put call ratio usually means investors are super bullish or bearish. What that means right now here in August, September of 2023 is that the put call ratio is telling you the options market, or the futures market, options market, it's way more bearishly positioned than you'd probably expect at this part in the cycle. And if you look back, this has identified some of the key bottoms. This is one of the bullish arguments I think you could make. A high put call ratio suggests investors are making a lot of bearish bets, and that usually means the opposite probably going to come. So that's what I think is up with the put call ratio. With any options ratios recently, of course, the 0 DTT options, still I think an open question as to what sort of impact they have had and will continue to have on these ratios. But, based on my work, that's what that's suggesting here now. Next question, Dave, how do you use the ATR, the average true range, as a stop? I've mentioned that in a couple different episodes, something about, using stops and just different best practices of how to do so. When I mention using average true range, it's implying sort of a higher level thinking, which is to say, if you're looking at a chart like, Eli Lilly, for example, right? We have a sense based on how Eli Lilly normally trades. If we look at the daily movement, close to close, high to low over time, you get a sense of the normal trend. Now, certain stocks and sectors tend to be more volatile and tend to have bigger price swings. Think of like a biotech stock or emerging technology names or like a cryptocurrency, right? Big volatility, big percentage gains on the upside and the downside, so more volatility. Low volatility groups would be things like utilities and real estate, things like that. So they tend to be a lot less liquid. They trade a lot less heavily. They tend to be more smaller movements, so lower beta, meaning lower relative movements to the benchmarks. And as a result, there's an implication that there's lower risk because if the market sells off, those probably aren't going to go down as much in a downward phase. So you benefit less during a bull market because they're not leading the way higher, they're not outperforming, but you benefit on the downside because they're not going down as much as the benchmark. So interesting way to sort of think about that overall. So if you think about those different things, right? Think about a biotech stock and a utility stock. If a utility stock's daily range is like this, let's say it's like 50 cents. And a normal daily range of a biotech stock is like $5. The average true range, the range day to day adjusted for gaps is just wider. So the problem is if you have the same stop for both of those stocks, this one is probably going to get triggered way more often just because it moves a lot. And this one that doesn't move often is never going to hit your stop. So what you want to do is make these stops bigger to adjust for the bigger volatility, make the less volatile stock the tighter stop because it's more likely to get triggered. So it's being smart about how you set your stops based on the dynamics of the price movements themselves. That's why something like an 8% stop, while a great simple mechanism, if you're going to use nothing else, something like if it goes down 8%, sell it sort of approach, that's better than nothing. Let's be clear. Having a process is better than no process, I think, for most of the time. Having a good money management discipline or a money management discipline is a great place to start. But as you start to refine your toolkit, I would be looking at things like average true range. Now, certain indicators are derived from that, and that's really what I'm implying, particularly something like the parabolic systems. While not really using average true range as you probably describe it, it is adjusted for volatility and has a smoothing, they call it an acceleration factor is what Wells Wilder built into it to sort of adapt to price movements. And then something like the chandelier exit, which Alexander Elder popularized in some of his books, is really derived from average true range. And that's where I would look. And if you just hit the magnifying glass on StockCharts, type chandelier, it'll get you to some chart school articles explaining that methodology. And you can add them on your chart just below where it says overlays. You want to do chandelier exit. If you're not familiar with them, read the article first because there's some things you want to do to make sure you're doing the long version or the short version, but the article has more time than I do to explain the nuances. And that's why average true range is a meaningful approach. Next question. Why are pennants and other reductions in volatility expected to resolve in big moves? This question came after we were talking about the S&P 500 earlier this week. And I had some questions based on this sort of pennant. I threw out the idea that maybe we're in a pennant sort of pattern, which is when you have a long move, and then you sort of have this pattern of lower highs and higher lows. And John Bollinger was the first that I remember, writing and speaking on this idea of volatility contraction and volatility expansion, right? So what happens in his theory, or at least as I remember it being presented, was you have a trending phase. So think of the S&P from March to July, a clear uptrend, again with some little wiggles, but overall moving higher. And then you have this consolidation of lower highs and higher lows, sort of settling into this range. His comment, when a stock really starts to move, the Bollinger Bands will widen, certainly initially, because we're getting very far away from the midpoint or from a moving average, whatever that middle point is. And so you're getting kind of far away, and as a result, the bands will expand. When things start to settle down, you come back into the middle, there's a lot less volatility, there's less deviation from the mid-moving average, and as a result, the Bollinger Bands will come in because less standard deviations away from the moving average. What happens is when you have that contraction, his argument would be that is the setup, right? That's getting ready for the big move. And his idea was the market moves in cycles. You have a big thrust, then sort of catch your breath, the digestion, figure out the new equilibrium, and then we move again. And John Bollinger's not alone in those sort of things. I mean, another strategist or a trader that popularized that would be Market Profile, Pete Steidlmeyer, and this woman Robin Mesh had done a brilliant job, studied with Steidlmeyer, and I think really moved the discipline forward. Thinking about how to apply Market Profile, which is the idea of stocks and commodities, futures moving in distribution zones. You have a distribution where the market sort of settles in, and then you have a new sort of establishment, a new area, and then you kind of set a new distribution, a new bell curve, and then you move to the new thing. And so that's a common technique or a common approach to thinking about price movements in stocks and in commodities as well. Next question, would you agree that, quote, technical signals lack reliable predictive value because they don't account for modern market rules? If you've watched the show for any amount of time, I'm sure you know my answer is no, I would not agree to that. You shared some additional information. You didn't mention where you had seen this, but you said you had attended a seminar where someone mentioned that quote. Said that technical signals lack reliable predictive value because they treat all prices as equal and that they don't account for modern market rules. I would disagree with the implication of that sentence and certainly the details that they're trying to explain. I think their general premise is incorrect. I would not argue that technical analysis treats all prices as equal. As a matter of fact, it's well documented. A lot of early strategists use volume as a way to differentiate. Is this a real price move or not? And we have other techniques. You're looking at RSI and other measures of price momentum, measures of market breadth. You're basically determining when is a price movement just kind of a regular move and when is something different, and recognizing that there is a signal at times and other times there may not be. Is it still valuable based on, the fact that markets have modernized, right? Think about decimalization. Think about Reg NMS, which is a best bid offer structure. Think about dark pools, high frequency trading. The number of things listed off is incredible. What's funny is 23 years ago, when I was starting in the industry in June of 2000, I remember my mentors, people like Ralph Acampora, would be asked, is decimalization going to kill technical analysis? And because they were just switching to decimals, they'd sort of done that initial thing, I think in like 1998. I can't remember the dates now, but it was something like that. I mean, decimalization was a new development for a lot of stocks. I mean, now it seems what obviously what you do, but at the time it was super unusual just to read stocks with decimals. And there was a big discussion, would that kill brokerages because the bid-ask spread would come below, an eighth of a dollar? Would this, all sorts of things, and then when the regional exchanges kind of go away, when you're not, no longer trading, electronic trading, that was going to kill technical analysis. Quantitative analysis was going to kill technical. I've heard so many things that are going to kill technical analysis. But I hope as we demonstrate on the show every day and as we demonstrate on StockCharts TV every week, these processes, these approaches still hold up. And I think because regardless of how the market structure has changed, at the end of the day, it's all about investor behavior. It's all about human beings making decisions and being imperfect in their attempts to do so. And while there are a lot of quantitative models and high frequency trading things, those are in many ways trying to model investor behavior. It is still trying to magnify the very real behavioral issues that investors have, where they get nervous and excited and desperate and panicky. And you see that every day when you look at stock prices. So questions like that, I feel like, are more academic ways of questioning the validity. I would say, philosophically, technical analysis is as valid as ever. And again, it's not just a judgment call. If you look up, Google momentum factor or trend following or relative strength investing, you will find plenty of evidence that shows, well-documented evidence, by the way, that explains still how there is information embedded in price, that price has memory, that a trend tends to persist. And by following trends, you can outperform the market. There are two persistent factors that keep coming up: momentum and value, meaning you buy strong stocks and they continue to get stronger, or strong prices continue to trend. And then value means you buy things below their intrinsic value based on some measurement. Those factors continue to work. And that's why most quantitative shops try to play off of one or both of those well-documented models. So that is my soapbox moment of backing up the technical discipline. But short answer is no, I would not agree with that premise. Next question: how do I add the Fibonacci scale to a chart? Great question, right? So let's bring up something like Apple, because I was just putting these on earlier today. So Apple's one of those names that I think is a perfect example of where you want to apply Fibonacci retracements. Take the low in January of this year, take the high in July of this year, and you can see we gapped lower. And right at that gap, that was around earnings in early August, we gapped lower, and then all of a sudden it's okay, hold on, maybe this uptrend, which has been incredibly consistent for the first 7 months of the year, maybe something's changing. So what you do then is, once you've had a trend and we have a clear beginning, a low, and then we have a clear peak for now, that's how you apply Fibonacci retracements. We have two different parts of the StockCharts platform. We have Sharp Charts and we have ACP. They both work in a very much a same way. Both of them have a tool to bring up annotations. In Sharp Charts, it's just below the chart. On ACP, it's just to the left of the chart, sort of on the top. Click on Annotate. In our platform, what you want to do is click on the little waves, which bring up all the different sort of overlays looking at price and time relationships. The very top one's called Fibonacci retracement. Click on that, then you click on the low. Click on the low, drag it up to the high, and let go, and you're done. So you've defined basically the low point and the high point, and these measurements automatically come up. This is 38.2% of the way down, around 170. There's 50%. There's 61.8%. Now, this is how we default to looking at Fibonacci retracements. In ACP, you have a little more flexibility at this point in terms of what levels. So there are secondary levels like 23.6%, which some people really like. ACP will allow you to use those, what I would consider more advanced uses of Fibonacci, or advanced levels, custom levels if you want to do them. The new version of StockCharts 3.0, which we've mentioned a number of times, and I know Grayson Rose has mentioned on his show, is coming later this year. That should allow much greater flexibility in terms of creating your own custom Fibonacci levels, different colors and everything like that. And the colors and line width and everything you can set up at the top of the screen and make it look kind of however you want. And then when you're done, just click on X, save the chart, and save it to some sort of chart list. And that's a really good place to track some of these charts that you're looking at. That's how you apply Fibonacci retracements. And again, I think it's most relevant when you've had a big move and then you kind of come back within that range. That's when you want to apply it. Next question, is the PEG ratio embedded somewhere in the StockCharts system? Yes, easy question. Yes, it is. The PEG ratio, if you're not familiar, you probably are familiar with the PE ratio. This is kind of an adaptation of that. The PE ratio is price to earnings, right? How much are you paying for $1 of earnings? So a PE of 1, which is pretty low and pretty rare, is you would pay $1 for every dollar the company earns per share. Now, the reason why that's pretty uncommon is because equities are a forward-looking mechanism, right? We're looking forward at not what this company's done today or to date, but looking forward. We're sort of pricing in the future of where we see these companies going. So it's normal to have a PE above 1 because you're paying additionally for the amount that the company is likely to gain. And with growth stocks, those valuations, as we call them, can get very, very high because when everything's going up and the price keeps getting higher, that ratio of pricing, it's not like it's making any more money. The quarterly earnings is what it is. So if the price keeps going up, the PE ratio is going to go up as well. On Sharp Charts and on the ACP, if you have the full quote at the top, we automatically show the EPS, earnings per share, and the PE ratio right at the top of the screen. And again, to be clear, I feel like we could do a lot more with fundamental data. We have plans to do so, but it's on the list of priorities for our development team. PEG ratio is not featured on the Sharp Charts. What you want to go is to what's called the symbol summary. You can get to there from two places, right? If you click on the link below, at the bottom of Sharp Charts, you'll see a link to get to the symbol summary, or at the top of our website, just change it to symbol summary and then bring up the stock LLY or whatever ticker you want to bring up. This is a great way to just capture some general technical data, fundamental data, earnings, analyst data, all those sorts of things. And if you go down, you will see here we have earnings and earnings dates here in this fundamental category. PE ratio of 85, PEG ratio of 5.1. What a PEG ratio is basically the ratio of the PE, the price to earnings ratio, to the growth. And this came from, I believe this is a Peter Lynch thing, if I remember right. I should know that. It's a former Fidelity strategist or managing director. I probably should know that. I was probably contractually required to remember a Peter Lynch development. I'm no longer part of that, but I think that rings a bell for me. But the PEG ratio is basically with more growth-oriented companies. It's not just price to earnings, right? It's not just price versus the earnings. You also want to know the PE, what's the valuation versus the EPS growth, right? The opportunity of the company to grow earnings. And so you want to have a higher PEG ratio. A higher PEG ratio would basically mean you have a higher valuation for a certain amount of growth. And so thinking about that PEG ratio as a way of recognizing the relationship between valuation, PE ratio, and how much earnings are actually growing. It's sort of like an additional factor to think about how much you are paying for potential future earnings growth. So PEG ratios are there. Our plans are to add more fundamental data. So if there are fundamental factors that you don't see on here that you'd like us to add, just let us know or let our support desk know for sure. We're always looking for new ideas. Next question, do you ever use monthly or quarterly candles? I won't say never, but rarely. And the reason is because, as such. Let's bring up a random thing. Let's bring up like the name that came to mind was Lucent, which where did that come from, right? We're talking about 2000. We're talking about when I started the industry. Lucent was like a big growth name there. So let's get away from that. So here we go. Here's a normal chart. We do daily chart's fine. We'll go down here and switch it to a candle chart. And let's make it a little shorter term time frame. Let's do it like a 6-month period. So candle charts, of course, are a form of analysis that was created in Japan centuries ago, back in the 1600s. They've derived back. And when I attended a conference in Tokyo a number of years ago, one of the Japanese technical analysts did a presentation on Hama, who was this legendary rice trader who basically created technical analysis in their estimation by creating candlesticks. He was a trader and he was able to do incredible things because he used technical analysis to identify turns and prices. And rice traders in the 1600s were using an early version of what we now think of as candlestick charts. It's a way of making a visually rich representation of prices, and it's the same data as you would get on a bar chart, but just visually, the fact that you have these open and closed candles, the reversals, when you have 5 days in a row that are closing higher, it almost jumps off the page at you. And that's why I really like using candle charts. Day to day, I use bar charts more than candles, only because I don't tend to think on this shorter term time frame as much. And candle charts are really designed to tell you about short term time frames, right? They're not a long term indicator. It's short term. Now, the reason, candle charts here, I'm looking at a daily candle. So each day has an open, right, at 9:30 Eastern. Each day has a close at 4 p.m. Eastern. And then the high and the low are the high and low of the range during that trading day. And I think why that's meaningful to me is because the open is a moment. There is a moment where we're waiting and then we start trading at the open, and it's sort of a start, right? It's a natural start. The close is an end of the day. That is the end of a session. Things trade around, and then we ended up at that point. And so that open to close movement has meaning. I would argue with something like a week, you could argue that's the same thing, because what you're basically doing is saying Monday's open to Friday's close, and taking a step back and thinking about the weekly movements in a stock price and how that's evolving. Let's bring in a little more data, like a 2-year period. Weekly charts, I think, have meaning too, because the weekend is a clearly defined barrier to that candle, right? Here's the problem. When you go to like a monthly candle, the difference from, June 30th to July 1st has literally no meaning, right? There's no big break. That could be a Tuesday to a Wednesday. That could have absolutely no significance. It's not like at the end of June, there's a big change, and then July is some different thing. It's just not, right? It's in the middle of a week, and it might just be some random day. So Monday through Friday makes sense to me. 9:30 to 4 makes sense because it's the same. August 1st to August 30th, I don't know if that's so seeing the candle on that period, looking at monthly charts to understand the trend over that time, and just seeing if we're going up or down and where we're at relative to long-term support and resistance levels, 100% yes, but not a candle chart. I don't think visually tells that much different. Now, a quarterly chart, you could argue, maybe, and the reason is because quarters kind of have a thing, right? There's a thing. There's often a definition between September 30th and October 1st, because it's the end of the third quarter, and there's a lot of money managers that do things at the end of the quarter and at the end of the year. But again, if there is a big bearish engulfing pattern on a quarterly chart, I think that has minimal value, and that may not agree with what you would see elsewhere. But in my experience, I don't get a lot of that. Is it helpful to look at monthly and quarterly charts to get a long-term trajectory of a stock or ETF? Absolutely, and I would not disagree with that. And I would think if you're a longer-term investor, you should probably look at more monthly and quarterly charts than you are, because that'll get you away from the short-term fluctuations, day-to-day movements in stock. But do candles on those timeframes mean anything special to me? Absolutely not. Daily and weekly candles, 100%. I have the same issue with intraday things, like looking at a 15-minute candle. It's not like at 3:15 and then 3:16 something changes. It's just another second. I mean, it just happens, right? So I'm not a fan of those being, and again, is it, do you look at prices on that time frame? 100%, yes. But does it make sense if there's like a hammer candle and that means something? No. On a daily chart, on a weekly chart, yes, that would make sense to me. On those other time frames, nope. Next question. India just hit another ATH, another all-time high. Is it too late? I would tell you it is never too late when you have something that's going up. And I just interviewed Ralph Akinpour this week. I interviewed Julius DeKempenaar this week. I interviewed David Cox from Raymond James this week for StockCharts TV. We had, conversations. We had our Charting Forward big market outlook special. If you missed that, check that video out because that was a lot of fun. Miss Schneider, Tom Boley, Julius DeKempenaar, we had a great discussion for about 45 minutes about a bunch of different things. But what strikes me about everyone that I just said, who are all very accomplished traders and market strategists, they have fairly straightforward approaches. And I would say very few of them, if any, would be afraid to follow a trend that is working. And the reason why I think the Nifty is okay here is the same reason why I would say Alphabet is okay here. Is there a possibility that this is the top for the year? Yeah. Do I think the chart will tell me and I will be able to minimize my losses because by here I will know that something's different? I probably want to get out of the way. Yes. And I'm willing to accept that I can buy into this trend that is going to maybe work. And my risk is the downside that I've top picked it. And if I can unwind those and they don't work, and stick with the ones that do work, that's going to be a pretty decent approach over time. I think that's what a lot of times with investors, we try to make a system or an approach that's going to be 100% accurate. Your goal is, anytime I get a buy signal, it works, and anytime I get a sell signal, that works. Life is not like that, and I have yet to find a single technical indicator, regardless of what you ever hear anyone claim, it never works anywhere close to 100% of the time, and it often won't work. And I think the game for a lot of investors is not to be right all the time, which is impossible. It's to admit when you're wrong and minimize your losses. To minimize your losses when the signal doesn't work and to maximize your gains when the signal does work. And the way you do that is by using a consistent process, sticking with winners and cutting your losers. And, Peter Lynch, I feel like it's a Peter Lynch special, but he would often say, cutting your win, if you sell your winners, that's like going to your garden and cutting the flowers and growing the weeds, right? What do you want to own? If you have a portfolio and you want to upgrade it, sell the stuff that's not working and buy more of the stuff that is. That's how you water the flowers and fertilize them and pull the weeds out. If you do the opposite, if you sell your winners, you're watering the weeds and pulling the flowers. And that's not the way you grow a great garden. It's not the way you grow a particularly good portfolio. So that's my long-winded philosophical way of saying I think the chart of Nifty is fine. I think new highs are bullish, and overall I wouldn't be afraid of that. Now, tactically, is it a good day? Is it a good moment to buy into that? That's where I think you have to be a little bit careful. Nifty's just getting above 20,000 this week, which is pretty impressive. We're overbought, and that on its own is not a bad thing. Overbought just means it's gone up a lot. Would it maybe be helpful to wait for it to come out of that overbought region and pull back a little bit, kind of like what we saw in July and August? Sure. Would I be happier buying on a pullback to the 50-day moving average? I would be more comfortable with that, but I wouldn't be afraid of being bullish on a chart that is making new highs, because new high, before something goes up 50%, it first has to make a new 52-week high and then go up 50%. So it may not be too early at all, or may not be too late at all. Final question. If there is a bullish rotation into energy, does that mean new money is coming in or money is moving away from other sectors? This is like an hour webcast, at least to answer this question fully. So I'll give you the quick 2-minute version of what this means. So what you have to remember is it's not a zero-sum game, right? If you think about something like ETFs, it's not like there's the 11 S&P sectors are a set list, and then investors are just rotating between those, right? And I'm drawn to a work that Walter Deemer, who was the technical analyst at Putnam Investments back in the 1970s and 80s, a really thoughtful analyst and a genuinely nice guy. Walter used to look at the Fidelity Select funds, which earlier on, decades ago, you would have to you deposit money into the select fund universe, and then you could just rotate between them. So it was really cool to do a switching model based on where are assets flowing. There's a defined basket of money, and it's rotating between these different funds. So is it going more to energy or technology or industrials or cash or what? And you can use that as a proxy of risk assessment. The ETFs that we look at now are not like that. It's not like the 11 S&P sectors. We can just see where the money's flowing. Things could be coming in and out. They could be going to bonds or real estate or cryptocurrencies or options or whatever it is, individual stocks, and then back into the XLU, and you're not going to be able to do it. So two things you can do. I mean, you could look at flows, and so there are a lot of tools. We don't have a lot of flow data on StockCharts, but there are platforms that try to promote flows. I know Bloomberg does a great job trying to report on flows. They have a great flow database because they have a market that they can track. So they can actually look at flows between different ETFs. So I would look at a place like that. If you're looking for data and insights on flows, what you would call fund flows or ETF flows. You can do the same thing with mutual funds and other things. Just look at the assets going in or out of these different vehicles. I would argue the best measure of flows of funds is price, right? Because if there's excess demand for something, the price is going to go up. And if there's excess supply or a lack of demand, the price is going to go down. I think stocks and ETFs trade a lot more like economics 101 than non-technical people tend to think. I think those basic principles work pretty well. So if you're going to know anything about ETFs, you want to know where the money's flowing, I would be looking at two things on the StockCharts platform. The first thing I would do is, this is our sector. I would make a chart list with the 11 S&P sectors, which I have right here. And then I would go to the performance report. And in ACP, we have the same report. And then you can basically look month to date or 1 month, 6 month, year to date, what's been working. And if you look at the last month, energy's up 4.3% and industrials are down 3%. And recognizing that shows you what the price moves based on what investors are doing. And if they're trying to buy more energy or they're trying to buy more consumer staples, the price will move as a result of that, right? That causes prices to fluctuate. The other thing I would do, as you may guess, because we refer to it sometimes, and I interviewed Julius DeKempener on the show this week, is use RRG. This is really meant to show the rotation of assets and how assets are flowing between different asset classes. So you can go to asset allocation, sector ETFs, and even as individual stocks within some of these different buckets. So those are the things that I would personally look at to gauge what that means. But that's how I would think about flows into energy versus elsewhere. That's it for the show, folks. Some really good questions. And I was excited as I looked through some of the questions we had recently. I was really excited to do this, to put the show together, because I thought it was a really fantastic list of topics to go through. We touched on a little of everything. Please keep the great questions coming. We'll do another mailbag, I think, on Monday's show, and we would love to feature one of your questions. So do me a favor, just shoot me questions that come up over the weekend. Our email, that's the best way to get them to us, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. On our YouTube channel, just below this video, put a question in the comment section. We gather all of those. We'll hope to answer your question on the air in our next mailbag segment. Also, don't forget, before you leave, give us a like if you wouldn't mind. Subscribe to our channel. It helps us a lot. It helps us promote the best practices of technical analysis. There's a lot of noise out there, and I feel very strongly that what we're doing to educate and empower investors needs to reach more ears. So help us along that journey. We would very much appreciate it. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great one. We'll see you next week.